Recently, a macro research firm named Citrini published a report titled, quote, "The 2028 Global Intelligence Crisis," which went viral and allegedly caused the markets to crash. And this is because the report outlined a hypothetical future wherein the economy and the markets would both struggle because of AI. In short, AI could replace white-collar workers, which would cause consumption and investment to fall. And since the economy relies on consumption and the markets rely on passive investing, both would struggle. In case the title didn't make it clear enough, Citrini, as well as Alep Shah, the co-author of the report, believe that this could occur as soon as 2028 because of recent advancements in AI agent technology. And FYI, Shah is also the CIO of Lotus Technology Management, which is an AI-focused investment firm. Anyways, before we break down the core arguments of the report, there's two important things you need to know. The first is that at the start of the report, it literally says, quote, "What follows is a scenario, not a prediction." This isn't bear porn or AI doomer fan fiction. The sole intent of this piece is modeling a scenario that's been relatively underexplored. But of course, everyone interpreted it as a prediction. And this ties into the second thing to note, and that's that the main argument of the report, that AI will replace white-collar jobs and thus lower wages, resulting in less consumption and investment that hurts the economy and the markets, is a potential side effect of AI that's been discussed for months, if not years. As such, the report was probably not what caused the markets to fall when it was published in late February. Funnily enough, though, Shah admitted in a subsequent interview with Bloomberg that yes, they, presumably Lotus Technology Management, were short various of the names that would be disrupted by AI. In other words, he and/or Citrini were short some of the same stocks that fell after the report was published. But once again, there's a catch. Many of these same stocks were already falling before the report appeared. And by the way, if you're enjoying this video so far, then smash that like button to let us know, and subscribe to the channel and ping that notification bell so you don't miss the next one. Anyways, the report begins in a very theoretical way, explaining that we are now in June 2028, and, quote, "The unemployment rate printed 10.2% this morning, a 0.3% upside surprise. The market sold off 2% on the number, bringing the cumulative drawdown in the S&P to 38% from its October 2026 highs." And obviously, that's because white-collar workers are increasingly being replaced by AI, specifically AI agents. The authors explain the theoretical negative feedback loop that's at play. Quote, "AI capabilities improved. Companies needed fewer workers. White-collar layoffs increased. Displaced workers spent less. Margin pressure pushed firms to invest more in AI, and AI capabilities improved." But there's one small sentence in the report that many readers seem to have missed and could already be coming true. Quote, "The velocity of money flatlined." Now, for those who don't know, the velocity of money refers to how quickly or how easily money is flowing through the economy and the markets. For example, if someone who's just got paid immediately spends their entire paycheck on Tesla merch or a Tesla stock, then that's a high velocity of money. If someone gets paid and saves almost all of that money, that's low velocity. And what the report's authors imply is that as white-collar workers start losing their jobs to AI, money velocity will slow simply because people won't have as much money to spend. And what's interesting is that the velocity of money has actually been falling for decades after peaking in the 1990s. And this suggests that the average worker has already been struggling for decades, and this is arguably due to globalization and automation. But this is significant because, if you think about it, AI is analogous to globalization and automation in terms of its effects on employment, except instead of work being outsourced to cheap labor and machines, it's been outsourced to AI and computers. The thing is, though, most of the layoffs that we have seen are reportedly not due to AI, even according to OpenAI CEO Sam Altman, but we'll come back to that a bit later. Anyhow, in the next part of the report, the authors explain that this dystopian 2028 scenario began in 2025, when companies saw that they could replace their software as a service or SaaS products with AI. Now, for context, software company stocks have been crashing recently because it's assumed that AI will replace the software that they offer. And this brings us to the first core argument of the report: AI replacing SaaS. What this argument misses is something that most AI maximalist arguments miss. Even if the technology is there, the trust is not, and that's because these technologies have not been battle-tested. Take Replete, for instance. It launched an AI agent to optimize code, and that AI agent went on to wipe the company's entire database. Large companies see this and they think the risk is not worth the reward at this particular time. In that sense, it's kind of equivalent to giving handguns to your employees instead of using dedicated security personnel. In theory, it enhances company security, but in practice, it increases the chances of catastrophic mistakes, especially if employees don't have experience on training with guns. And note that there are many instances of employees accidentally leaking confidential data with AI. Now, to their credit, the authors have a sort of counter-argument ready, and that's that the SaaS companies probably won't be replaced by AI. Instead, these SaaS companies will be forced to adopt AI to enhance their existing tools so they don't become obsolete. And the authors foreshadow a similar race to the bottom, where there's a smaller number of SaaS companies which have fewer employees and even lower profits. But once again, there's a sort of a natural hurdle rate here. If companies start competing on AI to the extent that the authors forecast in this fictional story, then it likewise greatly increases the risk, because these companies are guaranteed to cut corners. And some would argue that this is happening already, with the AI race putting enormous pressure on AI companies to provide ever more advanced products and services. Despite the fact that this rapid iteration makes it hard to achieve a stable rate of adoption for any single AI product or service, it exponentially increases the risk that something will go horribly wrong. Believe it or not, but there are some large companies that understand this already, most notably Apple, which has been taking its time with its AI rollout. It seems the markets have rewarded this strategy in recent weeks. In any case, in part 3, the report's authors pivot to another potential impact AI could have by 2028, and that's disintermediation. In plain English, AI will make it possible for consumers to access the best products and services, bypassing moats created by brands and habits. Suppose in the future you want to go on a flight. Instead of having to manually check every website for the best price, an AI agent would do it for you. Notably, the authors seem to suggest that the evolution of crypto payments will make it possible for these AI agents to act financially on your behalf, paying for products and services in stablecoins on crypto rails like Solana, for example. But again, the key takeaway here is the disintermediation. The fact that you will no longer, say, use a website like Kayak, and instead you will just use an AI agent. Logically, it's very bad for Kayak. But aside from the fact that many people might enjoy booking a hotel online, the problem of trust once again arises. It's one thing when you're trusting an AI agent to check your code or write a blog post. It's another thing entirely when you're trusting an AI agent with thousands of dollars to book a vacation for you. One mistake or even reading about a mistake and you'll think the risk is just not worth the reward. Regardless, in the fourth part of the report, the authors dig into the details of their main argument. AI and AI agents in particular, replacing white-collar jobs. White-collar jobs make up 50% of the employment and drive 75% of all spending. In the words of the author, white-collar workers are the economy. The authors start by highlighting the exponential evolution of AI agents using a real graph, not a false one. And this is where they make another assumption that everyone seems to have overlooked. Quote, white-collar openings were collapsing while blue-collar openings remained relatively stable. Construction, healthcare, trades. Later on, they explain that the loss in white-collar jobs results in more people switching to blue-collar jobs, suppressing blue-collar wages. But it seems the authors underestimate the demand. As some of you will know, governments around the world have started turning their focus to infrastructure spending. And even though most of this is related to the military for now, there is a lot of general infrastructure that needs to be built. According to BlackRock, governments will need to spend around $85 trillion on infrastructure over the next 15 years, assuming current costs. And according to BlackRock CEO Larry Fink, the US needs hundreds of thousands of electricians, just electricians. And that doesn't include the millions of other blue-collar jobs that will be required in the US, and the tens of millions of blue-collar jobs that will be needed globally. And this means that even if most white-collar jobs were to be displaced by AI, there will be lots of blue-collar demand that can't be replaced. Now, imagine if commodities are actually entering a supercycle, which is a very real possibility given historical trends. As a fun little fact, commodities follow a 30-year cycle, where prices rise for 15 years and then fall for 15 years. The last commodity cycle top was in 2011. Naturally, this suggests that commodity prices are close to bottoming or have bottomed already, and that prices will start rising over the next 15 years. And this would result in an even bigger surge in demand for blue-collar jobs, which would result in higher wages, better benefits, and other things that most workers have been trying to get since the 1990s. And there's also the social aspect. When you work a blue-collar job, you're usually working cooperatively with other people, face to face. And this makes it easier to form unions and demand more from employers. And this outcome seems likely given the circumstances, and it would break the doom loop that the authors of the report predict could happen by 2028. It's fundamentally based on the assumption that white-collar employment will continue to be the dominant form of employment, and they will continue to be the biggest consumers when historically it was the blue-collar workers that dominated both areas. And this really puts the terrifying quote of "there was no natural flaw to the labor market" into perspective. Not only is there likely to be a flaw, but the flaw will rise. It will just be a different collar color than office workers are used to, blue instead of white, a sector of the economy that is often forgotten, particularly by those who spend all day dreaming about how everyone will be replaced by AI, except them, of course. But before we go any further, you should check out our free weekly newsletter and our finance-related deals. Just click the link in the description or scan this QR code on your screen. It's completely free. Now, back to the video. And this pertains to a problematic assumption in part 5 of the report. And that's that white-collar workers will just go quietly into low-pay and blue-collar professions that the authors say will be disrupted by robots. On the contrary, if AI evolves to the extent that the authors imagine, then it means that crafty employees will be the one that are replacing their employers, not the other way around. And this is already happening today. Instead of hiring dozens of workers from low-cost countries, many new startups are using AI. And this underscores something that the report casually glazes over. And that's that the white-collar jobs that are the most at risk of being lost are not in places like the US and the EU. They're in places like India and the Philippines. And these are just the countries that will suffer the most from AI, should all of this come to pass. The fact that both startups and large corporations continue to hire dozens of workers from low-cost countries suggests that the risk of white-collar workers being replaced by AI is still relatively low. And that actually reminds me, you might have heard of the term AI washing. Now, this actually refers to a company that's firing people and claiming they're replacing them with AI, when in fact these people are just not needed anymore. As I mentioned earlier, OpenAI CEO Sam Altman recently alleged that many companies are doing AI washing, and that's not surprising. As another fun fact, it's estimated that as much as 40% of jobs are bullshit jobs, a very scientific term coined by anthropologist David Graeber, who found that a surprising number of people are doing work that's irrelevant or could be easily automated. Given this apparent fact, it's likely that most of the jobs being replaced by AI are bullshit jobs, and that there are still many bullshit jobs waiting to be replaced by AI. But make no mistake, people will cling to their bullshit jobs for as long as they can. The ones that don't will probably go blue collar, and the ones that do will go solo and replace their employers with AI. Come to think of it, the fact that governments continue to try and bring in foreign labor to do blue-collar work is proof that blue-collar wages and benefits would rise in the absence of the human supply. Fortunately or unfortunately, citizens around the world are increasingly voting for parties that restrict this kind of foreign labor, both legal and illegal. And this should keep blue-collar wages higher in the future. Whatever the case, in part 6 of the report, the authors dive into the, quote, daisy chain of correlated bets. It highlights another aspect of the report that seems a little bit off, and that's the fact that although it's set in the future, the scenarios discussed are happening today, like SaaS companies crashing. In the case of Part 6, the authors shine a light on private credit, which has faced issues lately because of its exposure to software. In the future, though, the authors believe it's possible that the intersection of private credit and insurance could create systemic issues. Now, the exact mechanism is beyond the scope of this video, but I'll note there is a link to the full report in the description, and it's free. Now, the last part that I want to focus on is a subsection in Part 6, and that's about mortgages. If people don't earn money, then they can't pay down their debts. Moreover, if white-collar jobs are in question, banks automatically seem less likely to lend. As the authors explain, this would result in housing prices falling, as existing homeowners default on their mortgages and prospective buyers are unable to get a mortgage due to concerns that their job is going to be outsourced to AI. And because borrowing is the backbone of the economy and bonds are used as collateral in the markets, like mortgage-backed securities, this ultimately puts pressure on both, causing the economy to slow and the markets to fall. The scary part is that the authors claim that any response from central banks will be ineffective because the death spiral is being driven by technology, not by financial conditions. In the last 2 sections of the report, the authors say that the government will need to step in with some form of UBI that will be funded by taxing the companies building all of the AI, something that Shah also mentioned in his Bloomberg interview. And they also make one final argument. Human intelligence is a scarce resource that will be made abundant by AI, and human intelligence will lose its premium. Now, as you might have guessed, a lot of people had a lot of things to say about Citrini's controversial report. However, nobody was expecting Citadel Securities to come out with a report of their own containing some heavy-hitting counter-arguments. Now, for reference, Citadel is one of the most profitable hedge funds in the world, so you can think of it as being like Citadel versus Lotus Technology Management. The Citadel report starts off by pointing out that the number of job postings for software engineers is rising, which is not what you would expect if all of these jobs are being replaced by AI. It's solid data to back up the anecdote that we mentioned earlier. If all of these white-collar jobs were at risk, we wouldn't be seeing so many companies hiring foreign white-collar workers, as they would be the first ones to be replaced. The authors of the Citadel report also point out that AI usage has not been growing exponentially, with only around 10% of people using AI for work. This probably has to do with something that we mentioned earlier, and that's that so many new AI products and services are coming out that it's hard for people to keep up, much less learn how to use these new tools effectively. It requires a lot of time and effort. Most importantly, however, Citadel takes a swipe at Citrini's final argument about the premium of human intelligence. Quote, displacing white-collar work would require orders of magnitude more compute intensity than the current level utilization. If automation expands rapidly, demand for compute definitionally rises, pushing up its marginal cost. If the marginal cost of compute rises above the marginal cost of human labor for certain tasks, substitution will not occur, creating a natural economic boundary. Citadel also flips Citrini's argument of AI adoption lowering wages on its head by noting that AI adoption means increased productivity. Increased productivity means a supply shock, and a supply shock means everything becomes cheaper, allowing for more consumption. And it also means higher margins for businesses. And what's fascinating is that Citadel provides a chart of new business formations. As you can see, the number of new businesses forming has increased exponentially over the last few years. And this is circumstantial evidence of something we mentioned earlier, and that's that employees who are determined to work will eventually replace their employers with AI. With AI agents, you don't need to hire an army of developers or SEO experts. You can be the boss of your own virtual company. Be that as it may, Citadel also reiterates what Altman said recently, and that's that there is little evidence that AI is disrupting the labor market for the time being. And this could very well change, but it will be hard to tell when companies are firing more and hiring less because of a weak economy and bullshit jobs versus actual AI replacement. And some would argue that this is exactly what we're seeing already. But again, even if AI replaces white-collar workers, there's still the issue of trust, which Citadel expands to, quote, coordination frictions, liability constraints, and trust barriers. And these will not be possible for AI to breach, and the result is that there will still be a need for human involvement somewhere, if only to take the blame. The second last sentence of Citadel's rebuttal, however, is truly profound. Quote, today's secular forces of aging populations, climate change, and deglobalization exert downward pressure on potential growth and productivity. Perhaps AI is just enough to offset these headwinds. And the bit about aging populations is worth double-clicking on. In case you didn't know, the main reason why people aren't having kids is because of rising costs, and demographics are starting to peak globally. And this means that in the coming years, the supply of labor will shrink, mainly skilled labor. If AI evolves to the extent that Citrini projected in their report, then the downward pressure it would have on wages would result in even less population growth, eventually resulting in a labor shortage of some kind, presumably blue collar. And this would result in higher wages and better benefits, and more family formation. In practical terms, then, AI could be no different from the technologies that came before it, something that Citadel argued in their report. Yes, there is disruption, but eventually there is a return to equilibrium, and it doesn't change the underlying cycle, much to Citrini's chagrin. It's nice to think about reaching escape velocity and creating some digital AI god, but nature will always have its constraints, so to speak. The same is true for the constraints of economics, and if you want to know how the growing debt load could crush the US economy and the markets long before AI takes over, then you can learn more about that by watching our video right over here. Thank you guys so much for watching. I'll see you again soon. This is Nick, signing off.